So you think your federal retirement pension is enough? I'm going to show you in today's video why most federal employees probably fall short. Did you know that your first pension might leave you with just 30% of your current salary in retirement? And that's before I uncovered hidden costs that go far beyond simple deductions. Most federal employees think their pension, TSP, Social Security will be enough. I know I did, but I didn't understand how TSP truly works, and it can cost us a lot of money, especially over time. So in today's video, I'm going to reveal the hidden costs I found going through my own journey. And we're going to go over some strategies that you can possibly consider to create a retirement plan that actually supports the lifestyle you've worked so hard for. So stick around and watch the full episode. Jump to the chapters, rewatch it if you need to. I just want to make sure that you're not leaving your future to chance.
Our company, we're a faith-based agency based out of Northern California, and we have 200 agents in multiple states. That's the nice thing about being able to work online and being able to work remote. Now it's allowed us to be able to expand, but we are expanding offices to meet in person, especially when it comes to finance. It's a very personal thing. You want to actually know the person face to face and then have that conversation. We are also an all-inclusive full financial services agency. And what that means is we actually do retirement income planning, estate legacy planning. We can do asset under management. This was the question that people bring up, like, how do you guys get paid? So there's two different sets of financial services. You have the ones that are asset under management. Those are the financial advisors. They get paid by managing your assets, fees. They get paid by a certain percentage. How we get paid is basically the company compensates us. A little bit of background of my why I became basically a licensed financial professional. I'm about to exit the VA, but I emigrated from the Philippines in 1984 when I was 13, and this lady right here, she is my why. And I'm going to tell you, her journey has been definitely led by circumstances, definitely led by God. So when I was 7, my dad left for the US. When I was 8, he sent her papers for divorce, and we were in the Philippines. So at 8, she had to make a decision. Am I going to stay here? How am I going to provide for 2 children in the Philippines when you don't really make a lot of money? And she worked as a secretary. You know, she prayed about it, and she was led to get her visa. And then she left. She was gone for 4 years, but she would come home every Christmas. So that was a bittersweet time. That's why it's my favorite holiday. I got to see my mom. And then we were able to come here. So fast forward, she meets this guy in 1988, like this guy right here. He's like, you're too old for me. But he's like, persistent. Anyways, they had a great marriage. You can see that was his 91st birthday. So through circumstances, and basically he outlived his life insurance. So when he passed away at 92, and this is when estate planning needs to be important, so please think about that. 2 days before he passed away, he finally signed and recorded the quitclaim deed to put her name on the house. And then he passed away. She's 78. Her long-term care, her future is tied to the equity of that house. So because of that, I became passionate about how to educate people and learning how to educate myself. And this is why we're here today. So most of you know I'm a strategic planner, program analyst, and that's why this stuff really fascinates me. And then I'm about to retire from federal service on October 1st. And I wanted to honor these people here on the bottom right. So Michelle, she is a friend of mine. She passed away from a stroke in June. She didn't have any coverage. Through grace of GoFundMe and her family, she was able to live out hospice, but she didn't have a memorial. Then my friend here, I've known him since he was 15, and he's about to retire next year in February. So their plans, him and his significant other, their plans are like, hey, we're going to travel, we're going to do this thing. but she found out she has ovarian cancer, stage 3. And she just had surgery. Now she's about to go through chemo. Because they never got married, she doesn't have any coverage. Now it's a single income, and they didn't put any money away. So now it's like, okay, what do we do? So I'm sharing that story with you because I want the future, and you can see my blended family here. I want to educate them. So then that way we're building generational wealth. Now, the reason we're all here because retirement is going to look different for now. And I'll share that experience with you so you can start thinking about and planning. And I did pray about this. I could have waited, but I wanted to do it before October 1st because I want to share the experiences I'm going through with it and whatever wisdom I have and knowledge that you guys would gain some understanding from it. Okay, now who is this for? Anybody that's going to collect a pension from federal service, and then anybody that wants to learn how to bridge that gap, because there is a gap. And that's the biggest surprise. And our goal is to have no families left behind. We don't want anybody that's got a GoFundMe or struggling to pay for long-term care or struggling, to meet that income gap, especially in retirement. Our promise to you is I'm going to share the realizations that I've experienced. And then we're going to give you some applicable strategies, and we're going to give it to you in different stages, 40, 50, 60s, because there's going to be different things that you need, and everybody's in different stages, different financial journey. We want to make sure that we're sharing that with you. What I learned is first pension, that's what I have. Some people might have something a little bit different, but it's a 70% pay cut from our current income. Now, why is that important? As the cost of living is increasing, inflation, we don't really want to sacrifice what we have right now for something less in the future. And retirement benefits, when I was looking at it, there's hidden costs, and we're going to go over that. And it goes beyond the deductions. So this is when you start looking at the numbers and then what are the trade-offs. But definitely look at different things that's available to you now so you can start looking at your numbers and then start planning. Not understanding how TSP works, not just the mechanics of the software, but the timing of exiting, how are you going to transition, rollovers. My blinders for the longest, relying on my pension, TSP, and Social Security, thinking it's going to be enough. And as I run these numbers, I don't. So now how much do I really need to retire? Now, when you guys go back to work, your homework will be to download your total compensation plan from your GRB platform. It's going to give you entire listing of what your retirement will look like and project it. So right here, it gives me my high 3. Now I am going to be the early retirement. So mine is $2,700. So that's a big gap between the unreduced at 57 years, my minimum retirement age. But I don't want to wait until 57 because the way things are right now, there's a cap to being a W-2 employee. But when you're your own business person, there isn't a cap. The cap is you. So as long as you learn that and then you work hard and discipline, it'll be fine. But why is this important? Because it's a 30% gap. But then also there's talks of an estimated 5 years. Instead of a high 3, you'll be a high 5. So that average is going to possibly lower your pension. It didn't pass the Senate, but who knows if things get tough enough that they might revisit that. Okay. Now, next thing you get to look at is your Social Security. Go into ssa.gov, download your Social Security statement. Now, with me being 14 years away from retirement age at 67, I'm looking at the numbers. I'm like, all right, 67. And they're saying, you know what? Social Security is projected to deplete in 2033. Guess how old I'm going to be in 2033? 61. So I'm going to miss that 62. So I'm like, all right, I definitely got to start planning. Thinking about your pension and Social Security, even if you put that together, I make 130, 129, depending on how the retirement estimate's going to come out. So that's about 10 grand a month. So my income gap is about 7,000 if I look at my current income. So that's a huge, burden on Del, and then this is all pre-tax numbers. I know he can handle it. That's another reason I took the VERA, because if it wasn't for him, I'm like, yes, I would be on Teams, and I wouldn't be in this position right now. How are you going to fill in that gap? There's ways to do it, and I wish I knew about it when I was younger. I really do. So this is your first assignment right now. What I want you to do is put in your current salary, divide it, take your little phone, divide it by 0.04, and this will give you how much you would need to retire. The 4% rule, basically what they're saying is if you saved up this amount and you draw, like you took out 4% every year, you should not run out of money. That's why that number is so big. But you think 4% is going to be enough with the way prices are going up and then inflation? The value of our money right now would probably be a lot less in the future. So that's why you can't shoot for just enough. I'm shooting for my current salary right now. Because at 129, 130, that might not be the same kind of value because everything else might go up in price. Now, hidden costs of retirement benefits. So when you're getting ready to retire, you call the RSSO office. They're going to meet with you. They're going to give you an estimate of your benefits. There's two different sections. So they give you your retirement annuity, and then they give you reductions that permanently decreases your benefits. And it's automatic, like survivor benefit, that's automatic, 10%. If you're married, but you can opt out. And the process for that, for 10%, it permanently reduces it. You're only getting 30% of your annuity. Then they're going to take out another 10%. And then plus you have all these other deductions. I'm able to look at my health insurance premium and opt out of that because I'm a veteran. I get VA care. Eventually I'll be on his plan. Federal tax withholding, I opted out of that because as like a 1099, a self-employed business owner, you can manage your own taxes and have if you want to opt out of the survivor benefits, you'll have to fill out like a form. Your spouse has to sign off on it saying, I'm going to waive the 50% benefit. And we'll show you how you can actually reallocate that money. And the 50% benefit only benefits the spouse. What about your children? What about the rest of your family? So, okay. And this is what I wanted to show you. 10% is deducted from your pension, and then your spouse will only receive 50%. So if anything happens to me, Del would get $1,300. Woo! I know, right? Wow. So I'm like, so if you look at the big lump sum of like my current salary, that's like 15%. So that's nothing. And then plus I asked, I'm like, well, can I lump sum my retirement? They're like, nope. So now you have to think about like, how do I protect everything else? Adult children, anybody can't leave any of that survivor benefit, but I can use that 10% deduction and reallocate that. And then we're going to go over that as a strategy. So this is the other calculation. I want you to calculate your human economic life value. I know everybody's like, oh, okay, I'm priceless. But what this means is what would happen to your family if you're not able to provide income while you're working. So that's why it's only years before retirement. So if you could take your income, multiply the number of years. So for me, I plan on working for another 12 years. That's how much coverage I would need to make sure like my family is covered. So that's the stuff that you have to think about as far as what would it take to replace your income. This is the hidden cost of group life insurance for federal service. I didn't know that my group life insurance wasn't enough. Even if you max it out, my group life insurance was $700,000. That's less than, maybe around 6+ years to cover my family. Also, you're only able to change your contribution options if you have a qualifying life event, marriage, divorce, your children gets older, and then hired. If I would have known that I could have bought my own life insurance when I was younger, it would be a lot cheaper. We're going to go over that type of solution later. Now, if you want to keep the group life insurance, it'll double, and it's also term. So that means there's no cash value. You're just putting money. And then as you get older, it also increases your monthly premium. It doesn't have any living benefits because there's different types of life insurance right now. And then there's living benefits. Okay. That way, in case anything happens to me, it doesn't come out of his pocket, it comes out of insurance. Now, TSP mistakes. I know I blurred out my stuff, but I started way late. When Roth first opened for federal service, it was 2012. I started in 2018. And I didn't understand like matching. Nobody talked to me about, when you first start TSP, it's like G fund. Nobody told me how to like reallocate. I found out later how to do your distribution, how to, interfund transfer. I didn't know all of that. And then I didn't know that your match, like for your Roth, even if you're like, it's tax deferred. So it's not Roth to Roth. It's not tax free. Basically, like the bottom half of that square is 68% of my TSP is tax deferred. So I will have to plan on to convert that to tax free later. And we're going to go over the strategies for that. Because if you're a high income earner, if you try to do it at once, it'll be a huge tax bill. But there's a strategy to be able to do that in sequence. Okay, but that takes guidance. And then I found out like any type of withdrawals, you have to wait after 30 days. When you retire, you'll get your last paycheck. You get your annual leave. So if you can, max out your annual leave and just use your use or lose, because they're going to give you that lump sum and that's supposed to bridge you, because you're not going to get your full retirement to maybe about, they said 6 to 12 weeks. So there's going to be an income gap. And then they're going to give you maybe partial annuity, but then eventually you'll get your full retirement leave. So that just extends, but it doesn't count as money. No, only annual leave is money. Your retirement, yeah. So you get a little bit more of retirement. So they do a lot more of that calculation. If you're thinking about exiting, and then if they're restructuring things, we don't know how it's going to play out with HR and RSSO, if they're going to be like consolidated, and then that's going to cause delays. This is where I'm going to introduce you to EJ. Again, he is my mentor. He has been doing this for 8 years, and he is one of the founding members.
We're going to be going over lots of concepts, solutions, things like that. So please write notes, raise your hands if you have questions. But real quick, I just want to, give a round of applause again to Dana, just because, when we first met, she was a very open book. We looked at her finances, and she just has a passion for learning and helping people. And in fact, she's put lots of people in front of me, particularly her colleagues and other federal workers. And so again, and the last thing is, what Dana's sharing here is her personal stuff. So she's being vulnerable about what she's experiencing. So hopefully, whether it's you guys or maybe someone that we could potentially help with some of these strategies, how we could come up with a financial roadmap or plan, okay? But just a little bit about myself, just real quick. Okay, just like she said, I'm one of the founding members of Valorem Solutions. I think she mentioned I'm a registered nurse of 12 years. Okay, I worked at Kaiser Riverside for 12 years. I started off as a staff nurse, went into case management a little bit, and then eventually became a registered nurse manager. Okay, I started off as a client before I became a professional, basically developing a blueprint or a financial roadmap for you, tailored to you, okay, not cookie cutter, depending on your situation, your age, your retirement horizon, things like that. But let's talk about some strategies just real quick. There's something called the death zone that I think everyone should know about, okay? And if we were to look at basically where you are in your financial journey, everyone, whether you're an employee, a business owner, you go through these same financial phases in your life. So there's two phases. There's the accumulation phase, and then there's the distribution phase, okay? And the accumulation phase is where most people are right now. They're working hard, you're saving money, you're investing, you're trading time for that money, okay? And then there's the distribution phase. Everyone eventually goes into that, where you basically retire. So now the strategy completely changes, because that's more of the income planning phase. Okay, so if we were to paint a picture of what that looks like, it would kind of be like Mount Everest. The reason why for that is, I don't know if you know this, there's actually more people that have passed away climbing down versus going up. Okay, and so that death zone it says there 5 years before retirement and 5 years after. It's actually more like 10 years from what we've seen. Okay, and so this is where you want to start implementing different strategies, because what your advisor or the TikTok guru that you're following or whoever it is, the advice that they're giving you is more than likely still on the accumulation phase, when we got to prepare for that preservation and also going to the distribution phase. Okay. And so that's what we call the death zone. I like to call it the red zone. I'm a football fan as well. It's like the red zone of retirement, about 5 to 10 years before and 5 to 10 years after you retire. Okay. Now, one of the strategies, again, all these concepts and strategies we're going to be talking about today, it depends. It depends on your situation. It could work for you. It depends on your age or your retirement horizon, things like that. But one of the things that she kind of spoke about in regards to, your group term, okay, your human economic life value and things like that. So one of the things that we always want to take advantage of are financial tools, right, that have the best features that favor you, okay? One of those that she did touch on briefly is the IRS tax code 7702 that is attached to life insurance, okay? Aside from life insurance, there's a few others out there, but they are the only products out there that allow you to do 3 tax-free things. Grow your money tax-free, take income tax-free, and then if you were to pass away, pass that on tax-free, okay? And sometimes, again, depending on your situation, it could kill 2 birds with 1 stone, just depending on your situation, okay? So contributions grow tax-free, tax-deferred, okay? Gains are locked in annually. I like to think when you're kind of in that preservation, a lot of sports fans here, you may have heard of the phrase, offense sells tickets, defense wins championships. Mm-hmm. You got to start thinking about the defensive strategies in your finances, because it's a big, big deal, okay? That could actually give you a pay raise or a pay increase, because imagine when you're taking income during retirement, you don't have to worry about the other expenses or the unexpected expenses because you have the proper defensive strategies in place, right? We call that leverage assets, or sometimes you may have heard of these terms, risk management or risk elimination strategies. Some of those strategies allow principal protection, meaning if the market goes down, you don't have to worry about a penny of your funds losing anything. Again, there's trade-offs to that though, right? There's critical and long-term care benefits. This is huge. Number one reason retirees go broke or file bankruptcy is usually due to a health condition, and long-term care costs go up. I'll share a story. Being in case management, I was the one that actually had to go to the family and the patient, tell them, hey, I'm sorry you're being discharged. By the way, your health insurance only covers this much. And you could just see, because of the financial burden it's going to cause the family, it just left them in chaos. That's why I only did case management for like a year or 2, by the way, right? I just didn't like doing that because I was the bearer of bad news. Tax-free retirement income, and then there's no IRS age restriction and contribution limits. And so here's an example for someone that's maybe younger, okay? There's different strategies out there, just depending on where you are, maybe how much you're making, right? But because of, for example, your group term or the FEGLI, again, you don't, one, it doesn't have living benefits. Second, you don't own it. And then when you do retire, premiums skyrocket, right? So one of the things you could do is look into a personal life insurance, because remember, in life insurance, the owner, the insured, and the payer could all be different people. You always want a personal policy where you're the owner and also the insured, okay? One of the things Dan spoke about is something called living benefits. So I always tell people these financial products, whether it's life insurance or something else, they're like cell phones and TVs. They always come out with newer products, different features. And so you just always want to be up to speed in what those look like. And so living benefits is where you're actually able to leverage your life insurance death benefit while you're still living under certain medical conditions, okay? Because what typically happens is a health condition comes, now you're forced to go into debt, pull some loans, sell your house, tap into your TSP, your 401k, you recover, and now you're starting off at square one with retirement, right? We see it all the time just because of there wasn't any leverage assets in place. So that's what living benefits is, right? And then if you do opt for maybe a permanent policy, cash value, you could use it as a tax-free income plan as well, in addition to your TSP. Most people we meet with, guys, it's usually they only have tax-deferred strategies. So what's happening is you have a ticking taxable time bomb come retirement. And if you look at the national debt, you will see it just continues to go up. And I'm very confident who's going to pay for that? It's going to be us, the taxpayers, right? And so that's the other thing. Some things that people don't think about as well when you leverage plans, whether it's this or something else, is that one, first off, it's not considered income. Okay. So because of that, it will not raise your taxes. Some people are pushed into the other tax bracket, and it is just a huge, again, tax bomb. It does not decrease your Social Security benefits, and it does not increase your Medicare premiums. So just other things to think about. You want to have some sort of defensive strategy where you could hedge, or if not completely eliminate when the market goes down as well, right? Again, we cannot ever predict the future, but whether it's a pandemic, recession, small corrections, you actually have to make more just to break even from your losses. So I tell people all the time, when the market goes down, think of it like you take a step back. We always have a rebound. You take a step forward, but because it takes more money to recuperate your losses, right? When the market goes down again, now you see yourself going 3 steps back. Rebound forward, right? And then another 5 steps back when the market goes down. And all of a sudden you're like, how come my money hasn't grown? Or how come it's just so little, right? And depending on where you are in your retirement horizon, sometimes you don't have enough time to recuperate your losses and even go above and beyond that. These are just, again, some things to think about as well. So here's an example that we actually did for one of our clients. This is someone that put $7,000, which is the actual Roth IRA contribution limit per year. I believe if you're over 50, it's $8,000, if I'm not mistaken. But they put that into what we call an index whole life, a cash value life insurance plan. Again, this was based on their situation, is they immediately had access to cash, right? Liquidity, right? You may have heard of the age 59.5 rule where you're penalized if you take money. So now they're able to use that money for whatever reason, whether it's to help with a down payment of the house or just emergencies. Because it's tied to life insurance, we kind of killed 2 birds with 1 stone, where she was able to actually get coverage at the same time, still build her tax-free income plan, right? And so for this one, they only paid into it for 20 years. So 45 years old to 65 years old. And you'll see here, right, the projected number of tax-free money, depending on when she decides to pull it, is right there in the green. And then also, let's just say she never touched the money. She also got the death benefit plus the cash value that they built in there. Okay, so it is a possible solution. And again, if you just continue to not touch the money, as you see, the tax-free money right there could continue to grow. This is something definitely long-term, for sure. So that's for someone a little bit younger, right? Now, in regards to maybe someone in their 50s, okay, because we wanted to, again, look at different profiles and different age groups here. You could apply the same strategy as the 40-year-old, but more importantly, we'll want to start looking at what we call the rule of 100. Basically assesses your risk. It's basically a concept where it says, okay, you're age 55. What that means is 55% of your assets should actually be in more safe, conservative money with fixed income, okay? What we find is every time we look at someone's assets altogether, it's more than likely 75% plus more on the riskier side. And again, and the reason for that with the rule of 100, why we want to apply is again, because of that death zone. At some point, you want to make sure that you're mitigating or eliminating risk, because the last thing you want to do is go into the retirement, get a 20%, 30% loss. Happened to my mom, by the way, when she retired from Kaiser, and now you lost a ton of money. Think of all the hard-earned money you worked for, and just because we did not make a shift in your allocations, you lost that. And those are dollars that are going to go towards your retirement lifestyle. Right? And so those are things we want to think about, okay? So the rule of 100, yeah, it's pretty simple. We look at what you all have, like your total assets, and we just want to compare, hey, what's on the safe side? What's more of maybe the idle side, and what's more on the riskier side? And we want to look and see how we could reallocate that and moving those funds around. When you look at your assets, you always want to make sure that you have your safe money. And then you also have your growth money, we call it, like a spend bucket, growth bucket. But also at the same time, you still want to maintain a form of liquidity, right? For emergencies, cash reserves, or even just opportunities out there, right? So here's an example also of someone that was 64 years old. They had about $350,000 in their TSP. They were getting ready to retire, but they already knew once we did the report that they wanted to transfer $350,000 into a plan like this. Okay, and then at age 65, as you see here, right when they did retire, the plan was to transfer the rest of the funds in there. And what we did is we converted that into a lifetime income stream. Okay, right here, lifetime income stream. This is actually per year, just so there's no confusion. Okay, so just to paint a picture, guys, in retirement, there's two sources of retirement income that you're going to rely on. Okay, there's what we call guaranteed income or fixed income, and then there's what we call accumulating assets. Okay, Dana spoke a little bit about the fixed income guaranteed money. That's Social Security. That's pension. That's something like this, a lifetime income plan. Okay, that's money that's owed to you, that's guaranteed for the rest of your life. Going into retirement, I like to think that you'd want to know how much money is guaranteed going to come to you every month, every year, versus not knowing what's going to come every year and every month. Okay, and the good news is when we did that, we actually gave this person a increase in their paycheck, what we like to call it, because as she explained, most people are following the 4% rule. Right? The 4% rule. We were able to bring it up to 7%, 8%, depending on when they decide to start taking this guaranteed income. Okay. Also in this plan, it has an impairment multiplier, meaning if they could not do 2 out of the 6 activities of daily living due to a condition, an accident, this company would actually double the payment that they're getting that year just to help with that for 5 years. So now you kind of have a leverage asset to help cover kind of like the long-term care scenario, right? So these are some things to think about as well, right? Again, looking at what you guys have and making sure that we're appropriately putting it in ways where you still have your spend bucket, your growth bucket, and other things like that, okay? The other thing too, so we spoke a little bit about the living benefits. $1 million death benefit, God forbid if she got this plan, it was enforced the next day she were to pass away, her family would receive $1 million, okay? The good news is that if she wanted to, depending what's important to you, depending on your perspective on legacy, if she wanted to, she could convert that into a permanent plan or a portion of it within the first 15 years. But the more important part are the living benefits right here. If you get a terminal condition, so there's cancer, chronic illness, critical illness for us men, heart attack, stroke, critical injury, traumatic brain injury, severe burns, like you're in a car accident, and the newest one in California, Alzheimer's, not newest condition, but newest living benefit, right? If any of those things were to happen in this scenario, like when she was age 63, this is how much she's able to leverage the death benefit by only paying $164.12. Okay.
And that's when I was talking about like how you can start looking to allocate. You can't shut it down, what we're getting as far as benefits, but you can start thinking ahead. It's like, okay, if I can start putting this money away instead of charging it later after I retire and they're going to charge me twice, I already have it. I can opt out.
We have so many stories in regards to living benefits. We had one of our agent's brothers, he developed cancer. He was able to tap into his living benefits, again, to help with medical expenses. In life insurance in general, one of my best buddies actually passed away this past year, and the family, he had a $6 million death benefit paid out. That was my first claim. I've been doing this for a while, but that was my first claim. Unfortunately, it had to be my buddy too.
Yeah.
Right? And so again, this stuff is real. This is what we call leveraged assets. Okay, making sure, and again, this stuff is to help avoid forcing your family to liquidate things, to go through your retirement, also leverage something else instead of going to everything that you work so hard for, you and your family.
And the thing too is like, this actually is less than my car insurance, but we pay our car insurance automatically. But this is like, you know what, that's going to help him if anything happens to me.
So when she gets approved, not only are they assessing if she gets approved for the coverage, they're also assessing if she'll get approved for this. So literally day one of her coverage, she will have living benefit access. This right here does just show a projected scenario of what it would look like if she were to make the claim at age 63.
And then also your rating will be different depending on your health status. I'm lucky enough that I'm healthy. That's why I'm wanting to get it now.
She would have access literally at day one to submit a living benefit claim. Now, the likelihood that she would do that, or that, again, they would do their research and of course they're underwriting a risk assessment. But let's just say it was like year 2, for example. She would have something similar to this because it is based off when, the age that she does it, the condition, and also the death benefit. Okay, healthcare costs continue to go up. This is why, again, we do recommend living benefits, long-term care. There's a growing population. Most people will need some sort of long-term care service, 70% over 65. The cost of healthcare just continues to go up in regards to whether that's a skilled nursing facility, home health. And the average nursing home stay is around 835 days, which can get very, very expensive. I've seen it myself. Longevity risk, people are just basically living longer. Okay, truth of the matter is, there's a reason why most people are retiring later. It's just the fact that there's just not enough planning, let alone healthcare costs, and just inflation in general just continues to go up. This is a long-term care plan where someone, and there's different options, but this is an example of someone that puts $100,000 premium into a plan like this. Now, if within this, it's a total of a 6-year benefit, okay, and the projected long-term care benefit monthly is $6,620. Okay, so someone put in a single premium of $100,000, but there's other options you could pay into it monthly. But this person decided to do a single premium of $100,000. Let's just say within the first 2 years they did not use that benefit. They actually, that's what the family actually would get paid, $158,880 if their loved one were to pass away. Okay. Now, if there's a 4-year, going to the 4-year benefit, they have access to about $317,760 in total long-term care services. But in total, if they were to do a 6-year benefit, and let's just say they were to use all of the benefit within the 6 years of the $6,620, that would be a total amount of $476,641. And even if they use that amount, they were eventually to pass away, a death benefit would still get paid out to the family. So why do we show something like this? This is a scenario where you, again, could use something called a leverage asset in the form of long-term care service, which again is a little different in comparison to living benefits. Okay, it's probably one of the most, by far, in regards to expenses for retirees. Okay, long-term care services. Okay. Okay. And so another strategy that we'll talk about is, anyone heard of Roth conversions? Roth conversions at all? The Secure Act of 2020, there's RMDs, required minimum distributions. They changed that from 70 to 73. They eliminated the stretch IRA for non-spousal beneficiaries. The stretch IRA allowed people to take withdrawals within a 10-year period. Okay, they removed contribution age limits 70 and a half to IRA accounts. They automatically increase 401k enrollments from 10 to 15%, and they encourage the annuities in qualified employer plans. Now, why do we bring this up? There's a common theme here. Uncle Sam's greedy. He wants his money, right? And so these are some things to think about. Now, a way to bypass that, here's more about the requirement minimum distribution. There's a 25% penalty if you don't take that at the age 73. Again, Uncle Sam wants his money. And then these are the required withdrawal amounts, just depending on your age, just for an example, percentage-wise. In regards to converting into Roth, what does that mean? It means paying taxes now for a known tax rate versus paying taxes later for an unknown rate. One of the concerns that we have is rising tax rates just because, again, of the national debt continuing to rise. But there's a strategic way to do it. There's a way that you need to do it strategically in order to avoid bumping yourself to another tax bracket. Because once you convert that, whatever that amount is, that counts as income. So here's an example of someone that has money in a traditional IRA. This is someone that, the next slide here, in regards to these amounts right here, the pre-tax amount, we were able to save someone in taxes about $480,784 based on having a traditional IRA, right, pre-tax account, or doing a single Roth conversion versus doing it the correct way, which is a series of partial Roth conversions, meaning transferring and making those into tax-free money in a series of years versus all at once. Again, avoiding pushing it to the next tax bracket. So here's an example after income taxes, right, and a net payout. Again, we want to make sure that you're doing it strategically to make sure that you avoid that, all right? And there's rules to it. It kind of depends also on, again, what you have and when you're going to retire. But sometimes you can turn your money into tax-free money, which is good because you avoid RMDs. And then if it gets passed on to your family, also tax-free, not leaving a financial burden for them. It's the concept of, again, paying what your tax rate is now versus potentially later, as we just can't predict. For example, TSP after age 59 and a half, that movable, right, and transferable, so we could do that. We want to make sure what your actual tax rate is, what your income is, so we avoid that. Yeah. We've seen some advisors move people's money in a single conversion, and it literally jumped their tax bracket by 10+%, right? Very, very bad. With the accounts, again, there's three options, right? First one is kind of not your retirement income's at a shortfall. Okay, your full skyrocket as soon as you leave. And then also your traditional conversion to Roth is just too late because of the huge tax bill. The second thing that we kind of find when we meet with people is they kind of do it, right? They have to do a lot of research, it takes a lot of time and monitoring, but also there's definitely a lot of costly mistakes that we identify. And then the last option, of course, is just getting a tailored plan for you, right? Looking at where you are and get to. What we want to do is look at your retirement, your expenses, your lifestyle expenses, and take that fixed income we spoke about and put that side by side. You're either going to have a surplus or a deficit. Now, if you have a surplus, fantastic. All that means is you don't have a lot of financial pressure in the future. But what can we do to increase that surplus from turning it to a paycheck to what we call now a playcheck, which we did on that one example when we increased the 4% to 7 to 8%. Okay. Now, if you have a deficit, that's where number two, the accumulating assets come into play. So again, that's like your TSP, your Roth IRAs, rental property, whatever else you have saved in long-term savings. That's where we'll want to look at that, strategize, and fill that void to that deficit that you may have. And the reality is, to be honest, most people have a deficit. It's just now planning ahead and what we can do with your accumulating assets and reallocations to fill that void. Most people, I like to think, correct me if I'm wrong, don't want to lower their lifestyle come retirement. If anything, want to remain the same or go up higher in their lifestyle in retirement, right? The other thing too is you have to remember that money you have to have that Roth account open for at minimum, I believe, Gary's 5 years, right? So that's another thing that you're going to want to consider as well in order to fit that. There's just so many different things. And then again, with all the different laws that are passing, it's something that we always want to be up to speed with. Your tax professional definitely want to talk to as well. Last key takeaway, I always like to ask the hard question, right? Because if we're not asking the hard questions, we're not getting our realization that Deanna spoke about. There's education and there's realization. From my experience, it's overrated. The reason why is because you could go to multiple workshops, you could read everything online, you could watch every TikTok guru talking about finances. At the end of the day, if you're not taking action, right, you're going to get the same result. And so we want realization. We want to make sure that you're making the proper pension elections. We want to make sure that you are getting the proper coverage because of the limitations of FEGLI. We want to make sure that you understand your TSP limitations, but also the options of that as well, right? Because that's just one thing. And then lastly, the single retiree pension ends and no legacy is left, okay? It's, again, everyone's different. This is our fully comprehensive financial planning firm as well. Meaning that we look at we look at it like a boat and we look at the holes of the boat to make sure that they're all covered. It's what I like to call a journey. It's not a small hike, it's not a short walk, it's a financial journey. And this is why we want to make sure we cover all your bases, because it doesn't just end with long-term care coverage or debt management or things like that. We do everything. The last thing I'll say is if you do not come from a wealthy family, then a wealthy family can definitely come from you, okay? And then just know, again, you always want a financial professional. You want to make sure that your financial professional is assessing your situation, they're understanding what's important to you, and I think.
I hope those insights were helpful. I know they were for me, and I'm glad that I was able to kind of go through the process to be able to understand and then learn how to shift. So I'm grateful for this opportunity to be able to share that with you. If you have any questions or any concerns and just want to know more, please feel free to reach out. My information is listed below. So just go ahead and either send me an email, send me a text, or schedule something on my calendar and we'll just chat. Anyways, again, thank you for watching. If you found this helpful, please share and subscribe.